Fitch's Fixed Interest podcast delivers the analyst insights and updates you need to stay ahead in a rapidly evolving market.
Hello and welcome to this episode of Fixed Interest. I'm Aymeric, Poizot, Global Head of Investor Development for Fitch Ratings. Today, let's talk about the Fed. With Kevin Warsh now in place as the new Fed chair, and following the latest FED meeting in mid-June, investors are certainly reassessing what may be changing at the Federal Reserve. Not just in tone, but in the way policy is set and what that means for markets. Today, I'm joined by our Chief Economist, Coulton, to discuss what this apparent reset could mean for rates, Treasury yields, and ultimately credit markets. Brian, thanks for joining us. Let's start with the reset itself. Brian, beyond the change in style, what do you see as the most substantive shifts in how this Fed may approach policymaking? And should investors take the reform agenda at face value or be cautious about assuming too much too soon?
Thanks, Aymeric. Kevin Warsh certainly started with a bang, right? It was a very, very different press release and conference. Hardly any discussion about the state of the US economy. Instead, his main focus was to announce these 5 task forces, of which I think 2 are potentially really quite consequential. And I think the 2 that you should really focus on are the shift in the Fed's communications policy and the potential focus on shrinking the Fed's balance sheet. I think the other 3 task forces, although they look pretty important and pretty profound, they kind of look a bit more to me like kind of just spring cleaning of the Fed's core tasks. So got to be looking at data, got to be looking at the impact of AI on the economy, got to be looking at the Fed's inflation measures and inflation models. That's all kind of stuff the Fed would have been doing anyway, to be honest. So, I mean, it's I can see why he's collected it all together and said, yeah, we need to take a fresh look and get a fresh pair of eyes on all this stuff. But I think those are all things that the Fed would be doing as a matter of course. But coming back to the change in the communication and the balance sheet, though, the strong overarching theme here, I think, is that Kevin Warsh seems to think that the Fed has been too generous over the last few years, both with its balance sheet, just the number of times it's been prepared to expand its balance sheet to smooth out a market volatility and address the risk of financial stability. There's a strong sense that he thinks the Fed have been doing too much of that sort of thing, helping out the government's funding costs in the process. But also, you seem to think that the Fed has maybe gone a bit too far in terms of spoon feeding the markets in terms of what it's going to do with interest rate policy. He really wants the market to kind of make up its own mind looking at the data of what the Fed is going to do next. And a really important backdrop is that Walsh seems to think, and he said this several times, that the Fed has got work to do in terms of re-establishing its credibility on the price stability front. He referred on more than one occasion to the fact that inflation has been above 2% for 5 consecutive years, and he doesn't think that that's good enough. So pretty significant shift towards a more hawkish tone from that first meeting.
Now looking at the message from the latest meeting and specifically the rate decision and the dot plots, how do you reconcile a unanimous 12-0 hold with a more hawkish, as you just said, but somewhat divided dot plot that appears to point to another hike? Which signal should markets put more weight on, you think?
So before the meeting, our view was that the Fed was probably likely to keep rates on hold this year. And that was something that we kind of changed that opinion as the oil price increased, headline inflation increased, and we saw some evidence that core inflation has been rising. We have seen some of the core inflation measures heading up in recent months. But we didn't feel that would be enough to see the Fed actually raising rates. But I think after this meeting, it really does bring the possibility of a Fed hike later this year into the realms of what's a very plausible scenario. One of the things that Fed did say was that the labor market basically looks okay. That had been a big worry for the Fed 6 to 9 months ago, but the recent numbers and the revisions kind of suggest that the Fed doesn't have to worry too much about its employment mandate for a while on that view of recent developments. And yet there is this issue in terms of the Fed persistently overshooting its inflation target. All that said, though, you have to remember the Fed went into this meeting with the Fed funds rate generally above a level that most people would think was neutral, including the FOMC members. So if you look at the short-term economic projections, they all show that the long-run Fed funds rate is quite a bit below where it is today. So that's an important bit of context. The Fed is already operating what you could argue is a tightish monetary policy. And then, of course, the other development that's been going on has been that the oil price has collapsed. We're down at $72 as of time of recording this podcast. That's back to where it was before the US-Iran war. And a lot of the recent sort of kind of recalibration of Fed and broader central bank commentary and actions with the ECB hiking on rates has been a response to the hike in oil prices. Well, that's been almost completely reversed now, and so I still don't think it's a slam dunk that we get higher rates, but it's a significantly higher probability now than before that meeting, I would say.
Subscribe to Fixed Interests wherever you get your podcasts.